Yalimadat, and welcome. My name is Ali Jawani, and I am the IHPA National President. On behalf of the IHPA team and the Aga Khan Health Board, as well as the Aga Khan Economic Planning Board, we thank you for joining us today for IHPA Grand Rounds. Before we hear from our speakers, a little background on the IHPA. A Smiley Health Professionals Association was established in 1993 under the aegis of the Aga Khan Health Board. We have over 3,000 healthcare professionals in all disciplines. One of the key mandates of the IHPA is to foster and enhance networking. We organize local events to promote collaboration and professional development. We connect members with activities and social opportunities through newsletters, webinars, and social media. We have an active mentoring program through the IPMP. Ismaili health professionals are able to become role models and inspire youth in our community. The IHPA promotes health and wellness within the Jamaat and through outreach activities. IHPA volunteers have worked at local healthcare centers for impoverished communities. They regularly staff wellness centers in Jamaat Khanas and other Jamaati events. IHPA members were given the unique opportunity to serve and care for the Jamaat at the Diamond Jubilee Mulakat and give extraordinary service. The international portfolio of the Aga Khan Health Board has engaged over 50 IHPA volunteers in projects around the world. The focus is on strengthening clinical services, education, and building research capacity. There are many opportunities for you to become involved in the IHPA. The IHPA database is the anchor to all of our opportunities, so we encourage you to register. You can have a substantial impact, meet Ismaili colleagues, and help strengthen our community. We will be hosting grand rounds once per quarter, and if you miss it, we will have the recordings of the previous webinars online at akhb.theismailiusa.org. Today's webinar recording will be posted within 1 week. A bit of housekeeping. We'll be taking questions throughout today's session, and we will answer them towards the end. Please submit questions as you think of them in the question box on the bottom right of your screen. I want to thank all the people who made today possible, especially our colleagues today from the Aga Khan Economic Planning Board for the United States of America. We are honored to work with them today to bring you this program. Our speakers today include Karim Babel, who currently works as an accounting manager with Small Business Accountex, where he leads the accounting practice for Dunkin' Donuts franchisees. Karim has an MBA in finance from the University of Dallas. We have Roshan Ajani, who is a certified public accountant, a CPA, and a certified financial planner practitioner, and has been working in the financial services industry for over 20 years. He has a bachelor's and master's degrees in accounting, an executive certificate in business administration from the University of Notre Dame, and did his certified financial planner coursework at Rice University. Also, we have Jamil Habib, who works in insurance and financial services industries. Before we begin, we have an obligatory disclaimer. The Jamaati institutions do not endorse any product, person, or service. The information being presented today is for educational purposes. We strongly recommend getting professional tax and financial advice which may be appropriate to your situation. And now, without further delay, let's hear from our guest speakers.
Thank you, Ali, Yali Madad, everybody. On behalf of the Economic Planning Board, I would like to thank the Health Board and the IHPA for partnering with us and giving us an opportunity to present this to the members. For the next 60 minutes, we will bring to you a lot of information on different aspects of financial planning. My recommendation would be to please take it in stride. If there is a slide that you are interested in, feel free to take a picture or two of those. We recognize the fact that the membership of the IHPA, like our Jamaat, is a cross-section. And we will make an attempt today to try and cover different areas so that it is relevant to the different memberships of IHPA. The intent of today's webinar is to give you an introduction, hence the Financial Planning 101, to the different concepts within financial planning. And so with that, let's get started. The pyramid that you see on the screen essentially is a simplified version of what financial planning is. Regardless of where you may be on the economic ladder or where you are with your at this point with your plan, with your profession, everybody needs a financial plan. And in order to start your financial plan, you essentially, these are the three layers that you should be aware of. The very basic is the protection layer, in which we obviously talk about the insurance, debt management, emergency funds. The next layer is the accumulation layer, which obviously is the investments, retirement planning, college savings, what you have. And the final one is the wealth distribution, which is where we talk about the estate planning, wills, and so on and so forth. I'd like to clarify one thing, though, that it is not necessary for you to have completed one layer before starting the other. You can simultaneously work on all three of these layers. What you need to keep in mind is that to make sure that all three of these layers are being taken care of for you to have a good financial plan in place. In today's webinar, we will cover a couple of items within the protection layer and within the accumulation layer. So to get started, let me hand it over to our presenter, Kareem Babul, to talk about budgeting and money management. Kareem?
Thank you very much, Jamil, Yalimadad, everybody. So we are going to, as Jamil mentioned, we are going to be talking about budgeting, money management, a little bit of debt management, and we'll talk a little bit about emergency funds. And just as Jamil mentioned, we will be going through a lot of information and quite rapidly. If you feel that some piece of information on the screen is valuable to you, you can either take a photo of it or you can come back and look at the entire presentation when it gets posted on the website. So starting with the concept of budget, right? A lot of the information, some of the information at least, is going to be somewhat preliminary, known, but just to kind of revisit and kind of reinstate that what is a budget? Budget is basically something which gives you a good synopsis of what money is coming in and where is the money going, in what categories, in what buckets is the money going. Is that happening with your happiness, with your satisfaction, or is it happening in a way that some things are getting out of control and that you need to bring them back into control? That instrument is your budget and your budgeting process that helps you basically manage your money, what is coming in, what is going out, right? It allows you to never get surprised that oh my God, this is how am I going to pay for something? Because good anticipated life events, you will have planned for it as part of your budgeting process. What are the steps of budgeting? The first thing that you have to do is you have to make an accurate, realistic budget. And how we do that, we'll talk about it in a few minutes. The second thing that is necessary is that once you come up with a budget, then you have to stick to that budget. That requires making sacrifices, making compromises, adjusting. All of that is only possible if your entire family is involved in that first step of making an accurate, realistic budget. If it is done by just one member of the family, it will be very difficult for you to kind of dictate to have the whole family stick with that budget. But if the family is involved in making the budget, then there's a high likelihood of success. Another important part of the budgeting process is that you have to anticipate what is coming up next in your life. For individuals who are single, are planning to get married at some point, well, that is a life event. Things will change. You have to anticipate that how is your budget going to change with that life event. you plan on having a kid, again, a life event, your budget is going to change. Your kid grows up, goes to college, a life event. You have to anticipate these life events in advance and think about what will that do to your expense structure and your income structure. The same applies for your income side, that as your income changes in your career, your budgeting process has to be revisited with that. For good piece of the life, that is an increment that is going up. But then there comes a time period in the life when the income level starts to go down, and you have to plan for that as well. So this entire dynamic living document, living process is the budgeting process, right? So you create this budget, as we said, to identify wasteful expenditures, to get control over your choices, get a better idea as to what are your needs versus your wants, and what are your essential needs, your fixed needs, and so on and so forth, so that you can make adjustments. It allows you to make decisions in making commitments that should you go out and buy a $30,000 vehicle, or should you go and buy a $50,000 vehicle? Should you go live in a $400,000 home and make the payments on that? Or should you go and buy $1 million home and make payments on that, right? So all of that is going to be dictated by your budgeting process, right? The idea with the budget is that if things are not looking very good initially, it doesn't mean that we have to panic. It is a start of a process that we have to follow to make sure that things get better organized, and it will actually lead to a calmness in dealing with financial matters within your family, right? Because everybody is on the same page. Everybody knows what is going on, why the family is making certain decisions. Now, when we talked about that first step of the budget, there are these 5 steps in the budget. First, you have to determine your income, calculate expenses, set your savings or your debt payoff goals, analyze your results, and make adjustments, right? So let's dig a little deeper into each one of these. Income coming in. It doesn't have to be just your W-2 income from your work or your if you're an independent contractor, then just that income. It could be business income. If you are a student and you're supported by your parents, then it could be that income. It could be passive income, like income from a rental unit that you have or something like that. It could be interest. Whatever source of income you have, all of that you will factor into your budget, that this is all the money coming in. Now, in this particular example of your gross income, we're specifically giving an example of your W-2 income, your income from your employment. That let's say that you earn $25 an hour, you work 40 hours, means that you are earning a gross income of $1,000 a week, right? Your net income is your income after taxes. So from your gross income, when you pay your taxes, then what you get is your net income, right? What are these taxes that are getting deducted? One is your income tax, the federal withholding that your employer withholds from your paycheck and sends it on your behalf to the federal government or to the state government for your tax. The other one is your FICA tax. FICA tax is basically your Medicare and your Social Security taxes. Social Security, as you all know, you become eligible for that in your 60s, right? The thing that some of us don't remember is that it requires 40 quarters of paying Social Security taxes to become eligible for Social Security income, right? If you have not worked 40 quarters, it does not have to be contiguous, but if you have not worked 40 quarters is like 10 years if you're working at a stretch. But if you've taken breaks, then whatever, as long as you have worked 40 quarters and paid Social Security taxes, then you will qualify at your retirement age to get Social Security benefits. Now, are you going to wait until you turn 65 to find out as to what amount you've got coming? That will be a bad idea. You have to figure out right now as to what kind of benefits, what kind of taxes has been contributed on your income to the Social Security Administration. The way you do that is by going to the ssa.gov website, sign up with your Social Security number, and it will show you that this is the income that has been reported on your behalf to the SSA. And if that does not look right, you go back to your employer and have a discussion with them as to how come your income is not shown correctly. If they make a mistake, put in the wrong Social Security number or something like that, you will not get the credit. And before it gets too late, you need to get that rectified. So I generally recommend that, around Nowruz time period is a good time period to go to that ssa.gov website and find out what credits have been posted for the previous year for you. Okay? Now, this is for an income, sometimes we tend to not appreciate that how for a typical lifespan in America, the income level changes, right? And I know that all of you are in a whole range of income levels, but regardless of what your income levels is, you should understand that for most of us in America, this is how the income level changes. The earned income, the W-2 income changes over the lifespan. You see that an average American household earns $61,372 per year. However, that changes significantly by age. So you're as low as $40,000 to begin with, and then in your late 40s, early 50s, you exceed $80,000. But then what happens? Then the income starts to go down. The earned income, the W-2 income starts to go down. And with the longevity, what happens is that by the time we hit our golden years, our income goes down dramatically. And what is happening on the right-hand side? This is, and you all are aware of it, how longevity is going up. Today, individuals at birth are expected to live about 80 years. And this is the projection where, this number is going to keep marching up as years go by. So we have to be ready that our income level could potentially go down. Now, if you're sitting here and if you're like 45 years old, and let's say that hypothetically your income is $80,000, is that a smart point at that point to go buy $1 million home with 30-year mortgage? Because in 30 years, you're going to be 75 years old and you will still be making that note payment. And will you have the capacity at that time to make those note payments? That is the reason I present this information to you, that when you go for commitments, you have to think about how your income is going to change over the years. When you make long-term commitments, you have to really give some serious thought about that. Okay? Then talking about expenses, there are three major kinds of expenses that we can talk about. There are the fixed needs, your mortgage payment, your rent payment, your utilities. These don't change much, right? Then there are your variable needs, your food, your gas, your incidentals, right? Food, why is it variable? Because you could decide to go out once in a month, or you could decide to go out eat 5 times a month, and that is going to change how your expenditure comes about. But you have to eat, so you do need that food, right? Then there are your wants. Wants are things that are not essential necessarily, but wants does not mean that they're necessarily bad, right? Some could be very good. Some are actually encouraged. Like you will survive if you were not to go for vocational training or extracurricular lessons or camps and stuff like that. You will survive, right? So it is not a need to have necessarily, but if you do it, there's a chance of you having a stronger career to look forward to and stuff like that, right? So you have these three categories, and in the wants bucket, it could be good wants or not so good wants, right? Why is it important that you recognize this in your budget? Because if you need to make cuts, if you need to trim things, your fixed needs, you will have the hardest time to change immediately. Your variable needs, you will have more flexibility, right? And your wants that are not necessarily on the good side, you will have more flexibility, and you may even have the need to altogether drop them for the time being. So you must recognize which part of your budget it falls into which category, right? Now here I am giving you, sometimes we figure out when we talk about budgets, I usually recommend that you look at your bank statements for the last 3 months and you jot down everything into buckets like these that, okay, how much did I spend on food, on childcare, on medical, on housing, on transportation, et cetera, right? Go through and you will know exactly this is how much you have spent, right? Because just picking numbers from thin air that, okay, my food is going to be this much per year. Well, there has to be some rationale for that. So go look at your bank statements to figure out exactly how much you're spending. But then when you figure that out, how do you know that what you're spending is typical or atypical? Well, there's this website, and I've given the example of Greater Houston, but you can go to this website, livingwage.mit.edu, and you can find out for your family structure what people in your neighborhood, in your city, are spending for as a need item, not as a want item, as a need item. What are they spending, right? And then you can figure out that where are you in that, right? This is just a need thing. So it does not cover your education budget. It doesn't cover any of your wants, right? So if you want to spend on your wants, you need income that is substantially higher than what is given here. This also allows you that you decide that, okay, I'm going to move from Houston to LA. Well, what is going to be the change in your cost of living? You go to this website, it will give you that indication. You can figure out as to what kind of increase or decrease in income that you can survive with when you go from one city to another city, okay? So when you do this planning process, then you start setting up your goals. And these are your short-term goals, your mid-term goals, and your long-term goals as to how you're going to make tweaks and adjustments in your budgeting process, right? So, for example, you decide that you want to take a trip to Hawaii in 3 years, and for that you will need $4,500, right? And you don't already have that money set aside. You say, okay, I've got 36 months to gather $4,500, and so you decide that, okay, every month I will need to set aside $125 so that in 3 years I have the $4,500 that I can afford that trip, right? That is the planning process. You set up the goals and then you go for it and achieve it, right? This here is your general guidelines as to how much maximum you should be spending in each category. And when it says housing 28%, and let's say that you're renting right now and planning on buying a house, well, your savings for your down payment has to come out of this 28% bucket also. There's no other additional bucket that can get into. Your 10% savings is really your retirement savings that we will be talking about in the next presentation, right? So this is how your typical budget process should work. Now, you can go to Google and you can download a budgeting template. As I mentioned earlier, look at your last 3 months of bank statements, credit card statements, figure out exactly what have you done. And then you set your goal that, okay, this was my reality. Now this is what I need to achieve in whatever, 6 months, 1 year, 2 years time frame. You should also be making a budget for your next life event. That with my life event, this is what is anticipated. What is going to be my budget then? Once you have done that, there are a lot of questions that you need to ask yourself. Does your income exceed or equal your spending? Will you be needing another income stream? What if one of your income streams were to stop? What adjustments would you be able to make? How quickly will you be able to adjust? How easily and quickly can you reduce your wants allocation? How will your budget change with the next life event? Can you balance the budget today if the next life event were to happen today? If not, by when will you be ready for the next life event? Do you have that much time? If not, what can you do today to be prepared for it in a timely manner? If you have money left over at the end of the month, your income and your expenses are balanced, congratulations. If you can't trim enough from your wants in order to balance your budget, you will need to reduce your variable needs expenditures in the short term. And then you have to look for additional income sources to balance it. These are critical questions to ask once you do the process to analyze your results and to make adjustments. Okay? So now talk about a little bit on the savings thing. In savings thing, remember that 10% bucket is for your retirement. If you want to have money set aside for your first home, you need to have a separate savings bucket for that. If you want to go on a vacation, you need to have a separate savings bucket for that. If you want to save money for college, for additional education yourself, your family, have a separate savings bucket for that. If you don't have these buckets and you don't set aside these buckets, you will not get there. But remember that all of this can only happen if your income level is substantially higher than the living wage that we looked at from the MIT website, right? So your income needs to be substantially higher in order for you to set all this money aside. And one of the critical savings that we all have to have is our rainy days fund, right? So in the rainy days fund, you have 3 months, 6 months, or 12 months worth of expenses set aside. So the higher your monthly expenditure is, the more money you will need to set aside, more challenging it will be. But this is money that you're setting aside that is liquid, that's easily accessible, and you use it only for emergencies and nothing else, right? We have covered good number of these points that are given here. You can come back and look at this again, but I'm not going to deliver on this. So let's go on to the credits, right? And I'm going to just spend a minute on that because I'm running out of my time. I've run out of my time, actually. Secured and unsecured loans. There are good loans and there are bad loans. Good loans are backed with assets. They are assets that appreciate in value. Those are good loans. Your mortgage, you're in an environment where your home value goes up. That's a good loan to have. You have a business, the value of the business is going up. That's a good loan to have. What are you student loans? You're acquiring education. It improves your earning capacity. That's a good loan. But credit card loans are unsecured loans. They don't have any collateral. That's not a good loan. We should not have credit card debt. If we have credit card debt, we should immediately go after that and get that addressed and resolved, right? Auto loans, they are very lucrative sometimes, 1%, 1.99%, etc. But the asset behind that keeps depreciating in value. By the time you've paid up that loan, that asset is not worth even half as much. So depending on what your situation is, if you have the wherewithal, fine. But if you don't, think about that do you really want to put your money in that direction? Okay? 36% is the maximum debt that you can have. Let's say that you've got $1,000 income per week, meaning your weekly debt service can be a maximum of $360. This includes your mortgage payment and everything. If your debt is higher, jot down this phone number, call EPB's desk for debt management assistance. Okay? I'm going to finally end here with just a remark on credit. You can go to annualcreditreport.com. There are 3 agencies. You can get your report once a year from each one of them. Okay? So make a note of this website, and you can spread it out over the course of the year and access them. Here are some scores, what is considered good score and what is considered not so good score on your credit report. Okay? The lower your credit, the higher the interest rate that you will be charged, the less the opportunity to secure credit. That's the issue there that we're talking about. And here are some of the factors that go in determining your FICO score. Okay? The fewer credits requests that you put in, your credit score will improve. Timely payment, full payment improves your credit scores. All right, so with that, I'm going to hand it over to Jamil for the life insurance bit.
Thank you, Kareem. Yali Madad again. So the next 3 slides, I'm going to quickly cover 3 of the most important insurances that I think you being in the health profession should consider looking into. And so let's talk about life insurance first. In the life insurance, there are 3 things that I want to cover real quick here. First is who should have life insurance? And the answer to that is if you have dependents, if there are people that will miss your paycheck, and if you were to unfortunately go to the heavens, then you need life insurance. You should have, if you look at the formula on there, everybody should have an economic value, which is whatever age you are and the difference between your retirement age, you multiply that by the annual income, not taking into consideration any inflation, increase in future income. We're just taking a very linear approach here, just so that you have a benchmark. That is your economic value. The second question is, how much life insurance should you have? I am not a fan of rule of thumb, but I will tell you again from a benchmark perspective, you should have 10 times your annual income in life insurance, anywhere between minimum 10 times, and on the upper side, your economic value. Now, if there is an individual that has a higher income, then obviously instead of the annual income, they will want to look at what is their family's annual need to sustain themselves, which for most people is the same as the annual income. There are 3 kinds of insurances that you may be experiencing. One is the group insurance. Group insurance is essentially what you get from your employer if you are working for a company. It is usually low cost. They usually offer it to you 1 or 2 times without any additional money on your side and without any underwriting. If you do decide to go over that, underwriting does come into play, which then looks at your current health and so on and so forth. One of the issues that you may want to consider is that group term is probably not portable. What that means is that if you were to leave your company, you may not be able to go with it. Now, obviously, if you go to another company, you can get it there. But if you decide to go on your own, become a contractor or have your own business, then obviously you would not be able to take that with you. And the group term goes up on a yearly basis that you can create. For those individuals that may not have up to the opportunity to have more than 2 to 3 times their annual income, they may want to look for a personal policy. Usually term policies are issued by insurance companies. Most common is the 20 to 30-year term. They are also low cost. I have to tell you that in my opinion, term policies are great for young families because they may require, because they're young, they may have children, children have college costs coming up, and to protect those young families, you may require a large amount of coverage, and term would offer that to you at a fairly affordable rate. And the rates are usually fixed for the life of the term of the policy. The third type is what we call permanent. These are the ones that have a savings component attached to them, and you would have obviously higher premiums for these. They may not be appropriate for everybody. Mostly they are used for estate plans, for legacy planning, for children and grandchildren. If term is renting a policy, permanent is buying that policy. All right. There are different types that you may run into. You may have heard of whole life, universal life, variable universal life. My only thought on all of this is that I think that based on where you are in your life and what your needs are, one of these three products may be suitable for you. My recommendation would be that before you add or buy policy, sit down with an advisor to make sure that you have looked at your entire portfolio. On the next slide, we will talk about disability insurance. Now, for people in the health insurance industry, I think disability insurance is fairly important. It comes in short-term, long-term. For short-term, mostly if you are working for a company, they will offer it to you, and they're offer for free. Long-term is the one that you probably need to sometimes buy. If you are a individual in your own practice, then you would need to buy one of these, depending on what benefit periods you're looking for, what elimination period looking for. Your premiums would depend on those. I will tell you that your health will also come into practice, into the equation here, because this one also requires underwriting. I will tell you that social security disability is available, but it is notoriously very difficult to qualify for because of the bars that they have for proving health are pretty high. If you do qualify for it, it is free, although you should have earned enough quarters, what Kareem talked about, and the quarters are based on your age. If you are above the age of 50, then you do require 40 quarters to qualify for any kind of social security disability, or at least to apply for it. On the next one, let me very quickly cover long-term care. So I will tell you that in my opinion, long-term care is perhaps a biggest threat to the drain for a financial well-being for majority of Jamati members. And the reason for that is that I think that many of Jamati members have not necessarily thought out about long-term care. Contrary to popular belief, Medicare, which is the health plan that you get at age 65, does not cover long-term care. It only covers you for the first 100 days, and after that, you're pretty much on your own. You qualify for long-term care if you cannot perform 2 out of the 6 activities of daily living. I will tell you that long-term care tends to be fairly expensive, as if some of you have looked at it or probably have an insurance policy. It is there, but it is a hedge against a major cost in the future. So it is important to shop around, look for a company. I will tell you that you will find that the cheapest ones may not be the best ones, so please do your research. And like I said, it depends on your age, gender, your benefit period, waiting period, and obviously your health, because underwriting is also required. One thing to keep in mind is that the insurance cost, unlike the life policies, is not guaranteed and can increase over a period of time, and some companies have done that on a periodic basis. What is the best time to buy your long-term care policies? I will tell you, aim for 50s, because after 59, the rates increase tremendously. So my suggestion would be to look for a policy in your 50s, if not earlier, if you are at a risk because of your family histories or whatever, then perhaps you may need to get it earlier. But for majority of the people, it is recommended that you look at it in the 55 age group. I know I covered that fairly quickly, but the intent here was to give you a bit of a flavor. And so with that, I'm going to transfer this back to actually to Roshan Ajani to take us through the last portion of our presentation, which is investment, best practices, and retirement. Over to you, Roshan.
Thank you so much, Jamil. Good evening, everybody. First of all, I want to thank all of you for what you'll do, always what you'll do, and what you're doing right now is especially more important. So thank you, thank you, thank you. Well, we have three important points that I want to cover today. 20 minutes is usually an hour presentation, so I am going to be a little fast. Power of qualified accounts, I think this is one area which in my personal practice over the last 20 years that I've learned that this is very undervalued. People are not understanding this, the power of qualified accounts. That will be my first topic, asset allocation, diversification on investments. And the eighth wonder of the world is the compound interest. Well, we all know right now what the market volatility is going, economic uncertainty is there. So I'm not going to spend much time. I will just give you one example that we all know. If there is water on the floor or on the road, and if you have to walk on it or you have to drive on it, the best thing is to use caution. And I think the better word which Imam has used in the past on certain situations like this is prudence. Today, I think that word has to be bolded, underlined, and we all have to go back to that word in our own family, in our own situation, and analyze that word for our need. Just Kareem has given some information, Jamil has said something, and that's why you have to go back and look into what is the prudence that we should be using. Well, with all that said, the current situation is cloudy, it's raining, but still we have to plan for our future. And our past president of the country has said, do what you can with what you have, where you are, with where you are. So stick to your long-term plan. That's the key, because we have to, even if you're in your 40s, you have another 40 more years with today's longevity of life, and calculate your risk, recalculate your tolerance, and stick to it. So I'm going to do a little x-ray of our income. Typically, Kareem has briefly touched on that. I think this is one area where most of us make a mistake. If a couple who makes $100,000, who pays all these taxes, Social Security, Medicare is 7.65%, federal tax for the first 24,800, there's zero tax. Only everybody gets a standard deduction. The next $75,000, we are paying average about $20,000. If you live in other state where have taxes, we are in Texas, we are very, very fortunate. We don't have state tax, but for 44 states, they do pay state tax. So if you make $100,000, you pay taxes $20,000, the goal should be, your expense should be at $60,000. Kareem said 10%, I would say go for 20%, because income is not wealth. You may have one more zero in front of this thing, you may have lots of income, but this is where the starting of wealth happens. If you're in your 20s, 30s, 40s, if you haven't started saving, this is the beginning, the first step that has to happen to wealth, for a wealth accumulation. Now, I'm going to highlight one key concept here. The couple who makes $100,000, all of this income they're paying tax is at either 10% or 12%. All the way till $105,000, you are paying federal tax at 12%. Plus, if you have state income tax, you pay that also. Well, if you have a qualified account, I'm going to just introduce that, and I'm going to go into more depth, because I think that's the key thing we all need to focus on. Is there's two types of accounts in qualified accounts. One is the Roth, and the other one is traditional. Roth is a very new concept, relatively new concept in the late 90s, where you decide to take the Roth IRA or put money into Roth IRA or Roth 401k or a 403b in your cases. You don't deduct. You say, okay, Uncle Sam, I am going to put my money, I'm going to put my $20,000 in my 403b, and I'm not going to deduct. Because, and I would personally recommend for a couple like that who makes less than 105,000 that you should do that, because you're only paying tax at 10 or 12%, which is good thing. You'll never pay tax on this money, whatever it grows to. Now, for most of us, hopefully people in this audience, and not everybody is in that lucky 10 or 12% bracket. Many of us are in a very high bracket. Some of us probably must be in a 22, 24. By the way, once you cross that 105,000, the next 90,000 of your income from 105 gross income all the way to about 190 is taxed at 22%. The next 150,000 is taxed at 24%. And then comes the 33, 35, and 37% as you go higher. So this is one thing where if you are in the 25% bracket, 24% bracket, by the way, if you make about 240,000, 250,000, you are in 24% tax bracket. What does that mean in simple English? It means that you are going to pay tax on the top bracket of the last 40, 50,000 of your income. You're paying tax at 24%. Now, if anybody who is in that bracket have chosen not to take any 401k last year, I'm going to do an X-ray. I know you doctors like, or you medical professionals like this X-ray, and dentists like those X-rays. So I'm going to do an X-ray on just very this simple and get into the details so you can understand how important it is for your financial life. You know, there's a saying, it doesn't matter where you start, it's where you end that matters. So with these accounts, if you do a good selection, either traditional or Roth, it can help you go far, far ahead with whatever you have, whatever you save. So for example, if you had 250,000 income last year and somebody chooses not to take 403B or 401k, whatever your case is. So literally what you're saying to Uncle Sam, that I would like to pay my taxes. By the way, at 250,000, your taxes, just the federal I'm talking, is about 45,000. So it substantially increases as we go along. And you're saying, okay, I will pay tax and I will take my money and then I'm gonna do whatever, have some savings, invest it outside, buy the FANG stocks or whatever you're thinking of doing. Well, let me go on a little bit more detail that what if you had the same income? The limit for 401k for 2019 was 19,000, or this year is 19,500. So let's round it up to $20,000. At 24%, that's $5,000. So what, in other words, Uncle Sam is saying that if you open a 401k or 403b account and defer the 20,000, 19,000 into that account, we will not tax you. So by putting $20,000, Uncle Sam says we will reduce your tax burden by $5,000. Well, the state government comes and says, okay, if you put money into your 403b or 401k, we will also not tax you on that money, and that's another 5% for many cases. So that's another 1,000. So here we are. You open a 403b. Either you take 14,000 in your hand on the top 20,000, or you can leave your 20,000 in your 403b or 401k, the full amount. And for many cases, that even gets better when your employer, your hospital, your university, or whatever, in many cases now they start offering matching. Let's assume they say 5% matching from their side. Now they're giving you another $1,000. So by opening the right account, by opening a qualified account, you're just starting with 21,000 for one person of the couple. I mean, if you both do it, multiply that by 2, 21,000. If you didn't do it, if you say, no, I don't want it, I'll just take my money, I don't want to open all this 401ks and 403b, I don't understand, you are getting $14,000 in your hand. 14,000, 21,000, if I do my math right, that's about 50% on 14,000, which you have to catch up just to make up to that $21,000. I don't know about myself, I would not come anywhere close, but that's a very high rate of return for many years you have to make to catch up. And it gets even better because what you get in your 401k and 403bs is the tax deferred growth. Once you put money into your account, you are not paying tax on that income for a very, very long time. So make sure that you understand that part and take full benefit of it. When you set up these 403Bs or 401Ks, make sure you have beneficiaries, contingent beneficiaries, because if life-changing events happen, if something happens to you, whatever is on your 401K account, money will go to those beneficiaries or contingent beneficiaries. Okay, so far we have just talked about the account. Now let's talk about some investments. There are different choices. This is very basic, so I'm not going to spend much time into it. Stocks, bonds, mutual funds, ETFs, and indexes. How they stack up for risk? The safest of all is the bottom one where you say cash. Well, the cash won't generate income for long term if you are invested in your account for 10, 20 years. That's not going to generate income for short term. It may be safe. Bonds are next step, international, because there's a currency movement, that is another higher risk. Real estate, you'll say, hey, that's tangible asset. Why is it so high? Well, most of the time when you invest into real estate, it's more leverage. Then come stocks and international stocks. How the stock, all these categories have done over the last 95 years? By looking at it, the answer might be, why would I put anywhere? By the way, those bonds right now are paying about 3%. Money markets are paying about 1%. Historically, they were higher. So very important that we do asset allocation. You have asset allocation is you have to have some bonds and you have to have some stocks, because those are the two asset classes which go one north and one south. When bad time happens, stocks go down, you should have some bonds to protect you so you could be in the market, so you could stay in the market, because bonds are not there to make money, but they are there to keep you in the market for very, very long term. And over the years, that has really saved people who I know have stayed because of those 25%. By the way, the percentage should be minimum 25% in bonds and maximum 75% in stock. And on the other side, if you're conservative, even if you're in the 70s and you're saying, oh, I'm about to retire, or I'm retired, should I go all bonds? The answer in my opinion, is no. You should have at least some portion of money into stock, because even at 70, you have 20 years, could be 20 years that you could be invested. So 25% of stock is also necessary for retirees. I'm going to move on to the next step because I have a third slide, and then we have a case study that I'm going to do. So this is a simple example, what I just talked about. If you take a long-term bond, which is 100% of your money into long-term bond, currently that rate of return is about 3%. Standard deviation is that you can still lose about up and down in that portfolio. If you put 100% into bond, about 8% up and down in a normal situation. What does an asset allocation does? It just takes this money and spreads out into multiple classes: mid-term bonds, short-term bonds, large company stocks, small company stocks. And by just doing that, your rate of return stays the same, but your risk goes down by half. So it is proven. It is one of those Nobel Prize was awarded to something like that, this modern portfolio theory. And it is a very powerful tool. If you want to take more return, you can increase it to more into stock, less into bonds, and you can get higher return with the same amount of risk as the bonds. And how do these, now let's go to the third one, power of compounding. The power of compounding is rule of 72. If you want a long term, you take 72 is the number, and you rate of return that you're getting, say 6%, 8%, 10%, you divide 72 by that number, you could get 12, say 72 divided by 6 is 12. So it takes 12 years to double your money. So if you had just put $1,000 every year for the last 40 years and earned 10% return, your money would have grown by, for 40,000 invested, over $500,000. So this is the power of compounding. Money doubles and doubles and doubles. And that's why it is important when you invest think long term, because money is made over the year, money is made in the market over the long period, not on short period. Important part is invest, stay in the market, stay long term. Now, we saw in the previous slide, you'll say, why would I invest into bonds and not put all my money into S&P 500 or buy 5-7 FANG stocks? Well, if you were to invest it fully into S&P 500, you could see that if you started in January of 2008, by end of the year, 2008, you would have lost 43% in that year in S&P 500. If you extend the time of your investment, say I want to be invested for 10 years and all bad thing happen, over the 10-year periods, there has never been one period where the numbers were negative. We always come ahead if you stay there for 10, 15 years time frame. Bad things will happen. From October of 2007 to March of 2009, we were down 55%. Most people will panic and probably cash out. That's why it's important to have diversification. We just went through this cycle, this bull market, which was lasting for about 11 years. February 29th, we officially ended the bull market. And then we went exactly from here to back somewhere here very much in the last 3 months. So we are really in a different situation where a lot of volatility are happening. When you create an emergency fund, that's not the money you should invest. The 6 months, 12 months of saving, that should be cash, liquid cash. Don't worry about if it's not making money. Retirement is where you take risk, think long term, and invest. If somebody is in their 20s or 30s and they have 45 years to invest, for every $500 they invest today would grow to $6,000 with 6% rate of return over the next 45 years. And some of us may say, hey, I'm not 25, I only have 20 years. Well, even $500 today invested for 20 years will give you about $2,000. So I'm going to do a quick case study. This is 3 cases, and hopefully we'll wrap it up what I just said very, very fast. I'm sorry, I'm going a little faster than my normal. But say for a couple, the 3 couple example, one couple who are 28 years old, both work. Their income is 75,000 joint income. One makes 50, and the other one makes 35,000. One gets a matching, the other one has no 401k. They have 25,000 car loan, 10,000 student loan, and $5,000 in credit card loan at 18%. They're planning to have their first child in about 5 years. So how would they do? I would say still go back, try to take the 401k and take the 3,000 matching, which is 3%, and then pay off this credit card, because this is 18%. That's a very, very dangerous thing to have. The next one, if you have a 401k, the couple has a lot more income, $220,000. What they have been doing, they're paying their loans and car loans down, but not saving into 401k. This is sometimes happens a lot, where if you don't take benefit of your 401k, you are losing on the matching which your employer is giving. So make sure you don't let go that part. And again, the same situation here. The couple has done very well. They have paid off their house. They have very high income, but all of their money saving is sitting in non-qualified, and they are paying taxes even on the income that they have saved. So very quick wrap up on educate yourself, determine your risk tolerance, decide on your asset allocation, very, very important, stick to your plan, and monitor your performance. Again, for long-term investors, this is a big thing. Avoid fraud, avoid irreversible losses, do not speculate, invest, periodic investment plans, long-term. I think you should add money on weekly basis, monthly basis, just like we have a 401k, 403b. That is going to help you stay in the market for long-term. And we'll be going back to the take some more questions. Jamil or Ali?
Thank you so much. That was excellent. I learned a lot. I'm sure many members of our audience did too. So we're going to take a few questions before we wrap up. Jamil, the first question is for you. When can we sign up for long-term and short-term disability insurance at our work?
Yes, thank you, Ali. So, every year in your company, you have something called open enrollment, and that is when the time you sign up for your health insurance. You may sign up for your elections for your 401k, HSA, et cetera, that is the time that you can change your coverage for long-term care. For your long disability and short-term disability, or make any changes if you like. So yes, you can do it each year at open enrollment at your work. Those are usually around the end of the year, November, December. However, you can only change during the year if you've had a life change. For example, you've gotten married, or if you switch jobs, or you have children, they may give you the opportunity to make some changes, but generally it is only during open enrollment.
Thank you. So the next question is for you, Kareem. And as a healthcare professional with tons of student loan debt, I totally relate to this. How do student loans affect your credit score?
So, student loans, as long as you are regular in your payment, can only do a positive impact on your credit scores. If you have secured the student loan from a private source rather than a government source, then initially when you got that loan at that time, there may be a small temporary impact on your credit score, a negative impact. But as you build the payment history, now obviously payments come substantially later, but then at that point, as you become regular in your payments, your credit scores should come up quite well.
Excellent. Roshan, the next question is for you. Can you elaborate on the backdoor Roth IRA for someone who does not qualify for a Roth IRA? Also, are there any issues or catches for someone to use a backdoor Roth IRA?
Yes, there is. Backdoor Roth IRA is something where you can, for people whose incomes are higher than 192 and up all the way to 196 to 206,000 AGI, then you don't qualify once you go into Roth. But most of the currently Internal Revenue Service have not given any clear guidance on that. So personally, I would, since this is EPB and we don't want to highlight things that which are not very, very appropriate or given a green light from IRS, I will stay away from that for now. Some people would like, some even the brokerage houses are not ready to do that. My own firm would not honor backdoor Roth IRAs. But this is only for people who have 401k and now they have income is too high, and they want to still defer some money. It is one of those strategy, but not proven yet, not 100% clear yet.
Thank you. Roshan, there's also been multiple requests, and if you don't mind, can you show the slide that Kareem Babel spoke about to show the debt to income ratio and the EPB phone number if people have debt that exceeds that ratio? If you don't mind putting that up.
Okay.
While you're doing that, next question is actually for Jamil. Is it okay to buy insurance for children? For example, the Gerber life insurance that as a parent I get those ads for.
Yes, so yeah, that question comes quite a bit, Ali. So let me go ahead and sort of preface that. Look, I don't think there is a parent out there that intends to benefit from the loss of a child, right? Having said that, if many parents have used health insurance, life insurance for their children, to the extent that it is a savings account, right? So it is very similar to what you would do if you were to open up a checking account for them, or essentially a savings account for them at a local bank. To that extent, yes, it is something that you can look into. So as long as, so I'm not necessarily very well familiar with the Gerber product. But I think that you will know if you are in the market for something of that sort. I think you should look across the spectrum, because I think almost every insurance company out there offers a product of that level.
Okay, I appreciate that. Roshan, the next question is for you. I used to get a tax-deferred annuity or 403B from my previous employer. Now I'm a 1099 employer and do not have tax-deferred annuity or 403B. How can I start investing in a 403B by myself? Do I need to open another simple IRA account?
Well, if you are self-employed, there are many choices. You don't have any restrictions to open a 403B. You could go into a 401k because many physicians, they choose to go into 401k. 403Bs are usually more restrictive on the type of investments you can have. But lately, last 5-10 years, 403Bs are getting lenient. So there's no restrictions from IRS side that since you are a physician, you cannot be in a 401k. You could open a 401k just like everybody. You could pay yourself a salary in your corporation if you have established. I'm hoping you have established, and you do a matching to yourself from your employer, and that's very, very popular way for self-employed physicians or any medical professional, dentists, and all that.
Excellent. I'm going to follow up with another question real quick to you. In this volatile market, does it make sense to put our 401k in a rollover IRA or FDIC insured accounts?
Well, market volatility is still there. So by rolling over your 401k to IRA, it doesn't change. Those are both qualified accounts. One is offered through your employer. 401 and 403Bs are employer offered plan. So when you leave your hospital, when you leave your university, you could transfer your money either to another hospital, another employer, or you could transfer to your IRA. So it's very, very transferable. So once you transfer, then you decide what choices you want to pick for your investments. The accounts doesn't make the risk. Those are just similar accounts. Is what you pick, how you invest. That's how you decide how much risk you want to take. And obviously, if you are investing in for retirement, you should be thinking more broad. You should be thinking more maybe indexes, ETFs, and not individual stocks for your retirement. A portion of flavor is always good to have to give you some return, but very minimal portion, 5-10%, whatever, depending on your risk. But most of the money should be in a diversified, good mutual fund, index funds, ETFs. That would help you stay in the market for long term with asset allocation of some into bonds.
Excellent. You can tell where the audience's mind is at because the next question is also for you, Roshan. If the employer doesn't give them any 401k or 403b option, what is the best option? Can you have a SEP IRA and a 401k?
Well, if you're employed, if you're a W-2 person, unfortunately, you cannot. Either you are W-2, then the only choice you have with the employer. Now, if you don't have it, you still have your IRA. If you are under 50, this year you can do 6,500. If you're over 50, you get 7,500 for 2020. If your spouse have it, let him or her max out their 401k. And you can come back and take a IRA at least, which is, as I said, smaller amount, way smaller amount, but you can have that also. And it's very unusual nowadays not to have a 401k or 403b offered. Yeah, but we do come across those cases occasionally. But yes, you do have a limit, but much lower if you don't have a employer offered plan.
Understood. Question the same to you again. Let's say I'm married but filing separately, and as a married couple make more than $105,000, can I still do a Roth?
Married couple filing joint, yes, the limit. Okay, that's a very good question. Very good question. So for a financial planning perspective, so for example, a couple, and I'm going to just take one quick one, that a couple makes say $220,000 as married jointly or married couple. So $220,000 disqualifies you for Roth because your income is too high, because it phases out at 206. Well, if you have taken 401k or a 403b, and both the spouses take that 20,000 each approximately, now your AGI, your modified adjusted gross income or MEGI, falls below that threshold. So you can take your 401k at 220, bring your AGI down to 180, and take the Roth at the same time for both of you. So a married couple have the cash flow, max out your 401k, take the tax deduction, come back, open another bucket, another account, Roth IRA, if your income comes down below 200,000. And that is a very, very popular. And even if your income is not that high, if you make 160, 150, take the Roth and come and take the 401k also, because ultimately the goal is when you're retired, you should have different buckets. You should have a taxable bucket because everything which you're putting in 403b, 401k, IRA, traditional IRA, they all are taxed when you start taking your required minimum distribution at 72. But if you have a different bucket of Roth, IRA, or another account, cash account like a savings account or checking account or an investment account, it is a good planning when you're sitting and doing a distribution. Okay, I need 100,000. I'll take my Social Security, which is 30,000. I'll take 30,000 from my 401k, which is required minimum distribution. Then I'm going to go to my Roth and take another 10,000. I'm going to take from my annuity or another investments that I have. So if you have a good diversified investments, you could walk away with 100,000 in your retirement with 5 or 10 or 15% taxes. And that's the key. That's what you think ahead. And yes, so answer is you can do Roth, and your limit will being filing meted jointly or meted separately. Those are limits, and you can do both traditional and 401k.
Thank you. Well, let's mix up for a second. Jamil, this one's for you. If short-term disability is not offered at my work, any suggestions on where to obtain it? And is pregnancy covered? How long should the long-term disability be for?
Right. So Ali, if you work for someone that does not offer you long or short-term disabilities, the best option for you is to buy a personal long-term disability and a short-term disability. They can come together. And yes, they will cover pregnancy. Make sure that when you are signing up, you can have somebody look into that and make sure that the pregnancy is covered. As far as how long the disability, long-term and short-term disability should happen, look, I think that if you look at it, the most popular ones are the ones either that have at least a 10-year period or the ones that go to retirement. Ali, if I may, didn't get a chance to talk about this while I was talking about the long-term disability. I think one thing that people should consider when they are looking for a long-term care policy is the definition of disability. And I'll tell you very quickly. There are two main ones. One is called own occupation definition, and one is called any occupation definition. And I'll tell you very quickly the difference. If somebody is disabled and can't do their primary job, what they're trained for, but are able to do anything else, sit at home and answer calls. Now, if they had a own occupation on their definition on their disability, they will be considered disabled because they cannot do the work that they are actually trained for, because that was their occupation, and they will receive disability benefits from the insurance company. However, if they had a definition that called for any occupation, unfortunately, since they're able to do anything else, they are not going to be considered disabled and may not get a claim. So it's very important for people to look into that. Obviously, any own occupation policies tend to be a bit more costlier, but I will tell you that in the long run, those are probably more beneficial.
Appreciate it. Thank you. So, Roshan, we're going to flip back to you again. If your employer's not matching for a 401k, should I still continue to contribute in the current situation?
Absolutely, absolutely. Again, we talked about the deferral part of it. So there's nothing better if your employer matches, you should take care of it, and you should take it because that's free money. The next thing you have to look at it, what is your tax bracket? And then again, going back to the same example, which people always back off. They say my employer is not matching, so I've never taken 401k. Well, I mean, think of it. You're writing a check to Uncle Sam. So for example, you make 250,000 in my previous example, you're still paying at 24, 25% to just federal government and another 5% to a state government. So it makes all the sense to have that 20,000 full amount into your 401k, 403b, because if you don't do it, Uncle Sam says, okay, we'll tax you 25%. State government says, we'll tax you another $1,000 and we'll never send you a thank you letter also. I never had anybody got a thank you letter from Uncle Sam who are not done 401k. So the higher you go in tax bracket, if you are making 300, 400,000, it makes even more sense that you should take. Well, and Ali, another question, always argument comes, well, but what I have to pay tax on it eventually. It's only tax deferred, not tax free in a 401k. Well, if you are 40 years old today and you don't have to write a check to Uncle Sam till you're 72, I'd rather do that because have my money into my 401k, 403b, defer it for 30, 40 years, make money on it. And if I do it right, tax planning, I could walk away, definitely not paying 25%, could be much lesser if I do it right.
I was gonna say, at that point, when you're withdrawing it, your overall income will be less, so the tax bracket will be less, right?
Absolutely. And as I said, if you have different buckets, if you have a Roth bucket, you have another investment bucket, RMD is only, say, for example, somebody has $1 million saved for in his 401k, 403b. Well, Uncle Sam will say, okay, no, you have to start taking required minimum distribution at 72. That's at 3%, 3.5%. So on $1 million 401k, you only are required to take out about 35,000. And that too, I mean, that percentage is not changing much. You may have 2 million, you have to take 60,000. But think of it, you take the minimum, you replenish your other needs from your Social Security with your Roth IRA. So somebody who makes $400,000, $500,000 right now, maybe in 33, 35, 37% bracket. So while you're going in today, you're saving 33, 25, 35, whatever percentage. But if you do it right on the other side, you may just walk away with 10, 15, 20%. And for 30 years, you have the money in your account. So if you sit down and do the math, this is one thing most people are ignoring, and this is one of the best thing you can do for your long-term investments, because not only that you get deferral, most of the time you're getting money from Uncle Sam. If you do the math, you'll know it is very, very powerful.
Thank you. So we're going to take one last question because I know it's getting late. And Rosen, this is also for you. If you're employed, have a W-2, but also do consulting on the side and get a 1099, can you still have an SEP as well as an employer offered plan?
Yes, absolutely, you can. So for example, you said, but you have a W-2 right now, so your employer may offer you a 403b. Then you have a corporation that you work moonlighting at the side, and I have few clients, doctors who do that. So you make another, say, 100,000 doing that on the side. You could set up a 401k on the side for you, or maybe if your spouse is not working, you can put her as administrative person, and have a 401k. So the answer is yes, you can do multiple plan, being one at the employer side, the other one is as you're self-employed, and then you could also have a Roth IRA or a traditional IRA. Well, not traditional would not work because the income has to be very low, but the Roth IRA you could qualify if you're less than 200,000 with a married couple. So the answer is yes, yes, for both employer plan and your self-employed plan and your Roth IRA if your income is less than 200,000, all three at the same time.
Ali, this is Jamil. Before we move on to the last end here, I just wanted to remind people, I know that in certain cases, we've seen that people have very specific questions with regard to their financial planning. And I just wanted to sort of put it out there that the Economic Planning Board has a program called the FLPP, the Financial Literacy and Planning Program. And to the attendees, I'd like to tell them that these are done on a Jamaat Khana basis. And in those sessions, you do have the opportunity to meet with a financial advisor for a confidential one-on-one where they can sit down with you and actually look at your specific situation to make sure your planning is on track. So please look out for these sessions as we do them across the country, and inshallah, we'll probably come to your city fairly shortly. Back to you, Ali.
Thank you, Jamil, Kareem, Roshan. Thank you so much. I learned a lot. I'm sure our audience learned a lot. As Jamil said, they are doing so much excellent work in this space. This was supposed to be an introduction. If you want more information, please contact the EPB, attend their webinars. There's a lot we can all learn, and it's all important for all of us to think about our futures that we don't necessarily think about while we're taking care of our patients. So once again, thank you for joining us tonight. The recording of this webinar will be up on akhp.theismailusa.org within a week. Also, you'll be receiving an email in the next 24 hours that will have a survey. We please implore that you answer said survey. It helps us with future content. And we'll be sending out some links for some of the stuff that was recovered tonight. Thank you once again, and Yali Madad.